Let me paint you a picture. You've been saving for years. You finally have the down payment. You find the house. The listing says $350,000. The mortgage calculator on your phone spits out a monthly payment that feels manageable. You do the math, you feel good, and you start mentally decorating the living room. Then you close, and suddenly you're writing checks you never planned for. Property taxes you underestimated. Insurance that came back way higher than the quote. An inspection that flagged 3 things the seller wouldn't fix. Closing costs that ate another $10,000 you weren't expecting. Sound familiar? This happens to first-time buyers every single day in 2026, not because they're irresponsible, because nobody sat them down and showed them the real number. The full, unfiltered, all-in cost of owning a home right now. That's what we're doing today. No sugarcoating, no real estate agent optimism, just the actual math. With today's interest rates, today's insurance market, today's property taxes, and today's maintenance realities factored in. By the end of this video, you will know exactly what homeownership costs in 2026, and you'll be able to make a decision based on facts instead of feelings. Let's get into it. The baseline, what most people calculate. Before we talk about what homeownership actually costs, let's talk about what most people think it costs. Because the gap between those two numbers is where financial pain lives. Most people do this calculation. They take the home price. They put in their down payment. They plug it into a mortgage calculator. They see a monthly number, and they compare that number to their current rent. If the mortgage is lower than the rent, they think they're winning. Here's the problem with that math. The mortgage payment, specifically the principal and interest, is only one piece of what you actually pay every month. And in most cases, it's not even the biggest piece when you add everything up. Let's build the real picture from the ground up. We're going to use a $350,000 home as our baseline for this video. That's close to the current U.S. median home price in 2026. If your market is higher or lower, scale the numbers accordingly. The percentages hold. You put 20% down. That's $70,000. Your loan amount is $280,000. Now let's start stacking the real costs. Mortgage rates in 2026. Let's start with the mortgage itself, because rates matter more than most people realize. If you bought a home in 2020 or 2021, you might have locked in a rate around 3%. Those days are gone. In 2026, the average 30-year fixed mortgage rate is sitting in a range that dramatically changes what you actually pay over the life of a loan. At a 7% interest rate on a $280,000 loan, your monthly principal and interest payment is approximately $1,863. Let that sink in for a second. That's just the loan payment. Not the taxes, not the insurance, not the maintenance, just the bank. And here's the part that stings. In the first year of that mortgage, roughly $1,633 of that $1,863 monthly payment goes to interest. Only about $230 goes to your actual equity. So in month 1, you write a check for $1,863. You build about $230 in equity. The rest goes to the lender. That ratio improves over time. That's how amortization works. But slowly. Very slowly. In year 5, you still owe roughly $260,000 on a home you've been paying on for 60 months. This is not an argument against buying. It's an argument for understanding exactly what you're signing up for before you sign it. Property taxes. Next up, property taxes. And this one surprises people more than almost anything else. Property taxes vary significantly by state and county. But nationally, the average effective property tax rate in the U.S. sits around 1 to 1.5% of the home's assessed value per year. On a $350,000 home, that's $3,500 to $5,250 per year. Divide that by 12, and you're looking at $290 to $437 added to your monthly housing cost. And here's the part people forget. Property taxes don't stop when your mortgage is paid off. They go up over time as your home's assessed value increases. In many markets, they've been climbing faster than inflation. In high-tax states like New Jersey, Illinois, or New York, effective rates can run 2% or higher. On a $350,000 home in New Jersey, you could be paying $7,000 or more in property taxes alone every single year. For our baseline example, we'll use a conservative $4,200 annually, or $350 per month. Add that to your mortgage payment, and you're already at $2,213 a month. And we're just getting started. Homeowners insurance. The homeowner's insurance is the cost that has quietly exploded over the last 3 years, and a lot of buyers don't see it coming until they're already under contract. The national average for homeowners insurance in 2026 is running significantly higher than it did even 2 or 3 years ago. Climate-related claims, increased construction costs, and reinsurance pressures have pushed premiums up dramatically in states like Florida, Texas, Louisiana, California, and parts of the Midwest. Nationally, a reasonable baseline for a $350,000 home is somewhere between $1,500 and $2,500 per year. But in high-risk states, that number can be $4,000, $6,000, or in some coastal Florida counties, $10,000 or more annually. For some buyers in those markets, insurance has become the deciding factor in whether a home is actually affordable. For our baseline, we'll use $1,800 a year or $150 per month. That brings our running monthly total to $2,363. And we still haven't talked about maintenance, PMI, or HOA fees. Private mortgage insurance. Quick but important. If you put down less than 20%, your lender requires private mortgage insurance, PMI. PMI typically costs between 0.5% and 1.5% of the loan amount annually. On a $280,000 loan, that's $1,400 to $4,200 a year, or $117 to $350 per month, added to your payment until you reach 20% equity in the home. In our baseline example, we assumed a 20% down payment, so we're not paying PMI. But if you put down 10% on a $350,000 home, which is far more common for first-time buyers, you're adding another $175 to $250 a month on top of everything else. That's not nothing, and it can take years to reach the equity threshold where it drops off. If you're planning to put down less than 20%, factor this in. It's a real cost that significantly changes the monthly math. Maintenance and repairs. This is the one that gets people the most, because it's invisible until it isn't. The standard rule of thumb for home maintenance is 1% of the home's value per year. Some financial planners push that to 1.5% or even 2% for older homes, homes in harsh climates, or homes that weren't well maintained by the previous owner. On a $350,000 home, 1% is $3,500 a year. That's $292 a month, set aside for maintenance before anything actually breaks. And things break. The average HVAC system costs $5,000 to $12,000 to replace. A new roof runs $8,000 to $20,000, depending on size and materials. Water heaters, appliances, plumbing issues, electrical problems, foundation cracks, windows, gutters, every single one of those is your responsibility now. There's no landlord to call. The 1% rule is not a guarantee that you'll spend exactly that much every year. Some years you spend nothing. Some years you spend $15,000 on a roof and a furnace in the same month. The 1% is a savings discipline, a way of making sure you're not blindsided when the inevitable happens. For our baseline, we'll count $292 a month in maintenance reserves. Running monthly total, $2,655. HOA fees and other costs. If your home is part of a homeowners association, which covers a huge percentage of new construction, condos, townhomes, and planned communities, you're also paying HOA dues. HOA fees vary wildly. A basic single-family neighborhood HOA might run $50 to $150 a month. A condo with amenities, gym, pool, landscaping, exterior maintenance can run $400 x $800 a month or more in major cities. The national average HOA fee is currently around $200 to $300 per month for communities that have them. For homes without HOAs, you skip this line. For homes with them, it's non-negotiable and it goes up over time. We'll leave this as a variable in our baseline, but if you're buying in a development with an HOA, add it in. It's real money. There are also smaller ongoing costs people forget. Lawn care or landscaping if you don't do it yourself. Pest control, trash and recycling if it's not included. Water and sewer if it's billed separately. These can add another $100 to $300 a month, depending on your property and your habit. The full picture. All right, let's add it all up. We're buying a $350,000 home. We put 20% down, $70,000. Our loan is $280,000 at a 7% interest rate on a 30-year fixed mortgage. Here's what the monthly cost actually looks like. Principal and interest, $1,863. Property taxes, $350. Homeowners insurance, $150. Maintenance reserves, $292. Total monthly cost, $2,655. And that's the conservative, no HOA, no PMI version with average insurance rates. If you're in a high-tax state, a high-risk insurance market, or an HOA community, add another $300 to $800 on top of that. In a realistic scenario for a lot of American buyers in 2026, the true all-in monthly cost of owning a $350,000 home is somewhere between $2,600 and $3,400 per month. Now here's what makes that number hit differently. A lot of renters paying $1,800 or $2,000 a month look at a mortgage payment of $1,863 and think they're almost breaking even. But they're not comparing rent to a mortgage. They're comparing rent to the full cost of ownership, and that gap is real. The upfront cost nobody budgets for. We've been talking about monthly costs, but before you even make your first payment, homeownership hits you with a wave of upfront costs that shock first-time buyers every single time. Let's walk through them. Down payment. We've covered this. On a $350,000 home at 20%, that's $70,000. Closing costs. This is the one that catches people off guard. Closing costs typically run 2 to 5% of the loan amount. On a $280,000 loan, that's $5,600 to $14,000. Due at closing, on top of your down payment. These include lender fees, title insurance, appraisal costs, attorney fees depending on your state, prepaid property taxes, and prepaid homeowners insurance. Moving costs. Depending on how far you're moving and how much you own, this can be $1,000 on the low end for a local DIY move to $5,000 or $10,000 for a long-distance professional move. Immediate repairs and updates. This one varies wildly, but most buyers spend something in the first few months. New locks, paint, a piece of furniture that finally fits the space, a repair the seller disclosed but didn't fix. Budget $2,000 to $5,000 as a realistic first-year setup cost, even for a move-in ready home. Add it all together, and your true out-of-pocket cost to buy a $350,000 home in 2026 before your first mortgage payment is somewhere between $80,000 and $95,000. That's the real price of entry. The opportunity cost reminder. We covered opportunity cost in the rent versus buy video, but it's worth a quick reminder here with real 2026 numbers. That's $70,000 to $95,000 you're putting in up front. That's capital that is now illiquid. It's sitting in the walls of your house. You can't rebalance it. You can't sell a piece of it if you need cash, and it's not compounding in the market. If that $80,000 stayed invested in a broad market index fund, earning an average of 8% annually, it would grow to approximately $805,000 over 30 years. That doesn't mean you shouldn't buy. It means you need to understand what you're trading. You're trading liquidity and compounding potential for stability, control, and forced equity building. Whether that trade is worth it depends entirely on your situation, your timeline, your market, your income stability, and what the rental alternative actually costs you. When the math starts to work in your favor. So with all of this, is buying ever worth it in 2026? Yes, absolutely, but the conditions matter. First, the timeline. The longer you stay, the better buying looks. Transaction costs when you sell, agent commissions, repairs, closing costs on the buyer's side can eat 8 to 10% of the sale price. On a $350,000 home, that's $28,000 to $35,000 gone before you see $1 of profit. You need time and appreciation to overcome that. The general rule of 5 to 7 years still applies, and in today's rate environment, some analysts argue it's closer to 7 to 10 years before buying reliably beats renting in most markets. Second, appreciation. If you're in a market with strong long-term demand, supply-constrained cities, growing job markets, desirable school districts, appreciation can significantly change the math. Home values in strong markets have historically outpaced inflation over long periods. That builds real equity. Third, rent versus own comparison in your specific market. In some cities, renting a comparable home is actually significantly cheaper than owning it right now. In others, rent has risen so aggressively that buying is the more stable long-term option. You have to run the numbers for your specific zip code, not the national average. The question to ask yourself, before you buy a home in 2026, ask yourself these 4 questions. 1. Can I truly afford the all-in cost? Not just the mortgage, the full $2,600 to $3,400 a month we walked through today. Is that comfortable, or does it make my budget razor thin? 2. How long am I planning to stay? If the answer is less than 5 years, the math is almost never in your favor right now. 3. What is my opportunity cost? What could that down payment do for my net worth if it stayed invested? Is the stability and equity of homeownership worth more to me than that compounding potential? 4. Am I buying because it makes financial sense or because it's what I'm supposed to do? Because social pressure is not a financial strategy. Answer those 4 questions honestly, and you'll know whether 2026 is your year to buy, or your year to rent strategically and keep building. Here's the bottom line. Buying a home in 2026 is not impossible, but it is expensive in ways that most people don't fully understand until after they've signed. The real cost of a $350,000 home right now is not $1,863 a month. It's closer to $2,655 or more. The real cost of entry is not $70,000. It's closer to $80,000 to $95,000 when you factor in closing costs and first-year expenses. And the real question is not whether you can afford the mortgage. Run the numbers, know the real costs, make the decision with your eyes open. Because in 2026, informed buyers don't get surprised, and surprised buyers don't build wealth. If you want to see the next video in this series, a direct head-to-head comparison of index funds versus real estate over 30 years, it's up next. I'm Nick. I'll see you in the next one.